Good afternoon, friends. Welcome for the today's class. Today, we are going to discuss one more important topic, that is national income from business environment point of view. Now, we are going to straight away jump into the topic. What is national income? Now, coming to national income is the total value of all finished goods and services produced in a country in a given year, expressed in monetary terms. It measures the economic performance of a nation and is a key indicator of growth and development. So, what is national income? National income is the total value of all final goods and services produced in a country in a given year. Means whatever the goods and services which are produced in a country, the total value of all the final goods in a given period, that is the financial year, which are expressed in terms of monetary terms, all that income we are calling it as national income. And it measures the economic performance of a nation. Definitely, it is going to measure the economic performance of the nation and is a key indicator of growth and development. So, under national income, we have various concepts called. We are going with the gross value, we have net value, we have domestic income, we have national income, we have factor cost, and we have market price. So, we are going to discuss all these in the coming class. Right. Now, what is national income? So, if you go with the national income is the total value of country's final output of all new goods and services produced in a year. So, what is national income? NI means NI is the total value. NI is the total value of a country's final output of all new goods and services produced in 1 year. Now, next comes what is GDP. GDP is the total market value of all finished goods and services produced within a country in a set time period. Now, national income is the total value of country's final output, but where GDP is a total market value of all finished goods and services produced within a country in a set time period. Now, what is GNI? Gross National Income is the total income received by country from its residents and business, regardless of whether they are located in the country or abroad. So here we have studied what is the national income, what is GDP, and what is GNI. I will move to the next continuation. Now these are the concepts. These are the concepts of national income, and with a few examples, we are going to discuss what the concepts are called. So, out of this, the first and most important is GDP, gross domestic product. Next, second, gross national product. Third one, net domestic product. Fourth one, net national product. And after that, per capita income. So these concepts we are going to discuss in the class. Now we'll move to the first concept. Yes, it is gross domestic product. So gross domestic product GDP is the monetary measure. It is a monetary measure of market value of all final goods and services produced in a specific time period, isn't it? And it can be expressed in here. So GDP is equal to C plus I plus G plus X minus N. In other words, GDP is equal to C stands for consumption, I stands for investments, G stands for government spending plus exports minus imports. So here, what is exactly the GDP means? The GDP is the monetary measure of the total market value of all the final goods and services produced in a specific time period. So all these are need to be produced. So it can be expressed in terms of C plus I plus G plus X minus M, where C is equal to consumption, I is equal to investment, G is equal to government spending, plus exports minus import. If we calculate this, so we are going to get what is gross domestic product. Right now here, there are two concepts. What is a real and what is a nominal GDP? So before we calculate this nominal and real GDP, we should know what is the nominal GDP and what is a real GDP. So first we like to go with what is nominal GDP. So nominal GDP is an assessment of economic production in an economy that include current prices in its calculation. So please keep it in mind whenever you're talking about nominal GDP means for the calculation, you are taking the current prices. What the prices which is fixed by the government, which is prevailing in the market, those those are considered. Those are considered for the assessment. In other words, it does not stripe out the inflation or the pace of raising prices, which can inflate the growth figure. Now here, the inflation, fluctuations in the market, all these things are not considered while you are calculating the nominal GDP. So nominal GDP is an assessment of economic production in an economy, but which it includes only the current prices. Current prices. It is not bothered about how the inflation is there, whether it is inflation or deflation, whether the market condition, how the market conditions are moving. All these are not bothered by the nominal GDP. So nominal GDP is always considering the current prices. So this is what you need to keep it at. So based on the current prices, isn't it? And it is not bothered about the inflation like rising prices, and other things it will not be considered. Now coming to other side is the real GDP. Now what real GDP? If it is considering the current prices means definitely real GDP will adjust. It's based on its inflation. So how the market prices are increasing, how the conditions are there. On this, these are considered. So here real GDP is an inflation adjusted measure that reflects the quality of goods and services produced by an economy in a given year, with price held constant from year to year in order to separate out the impact of inflation or deflation from the trend in the output over time. So it is very clear from. So the real GDP is an inflation adjusted measure. So whenever the prices are high, things will be, the GDP will be adjusted. When the prices are coming down, the GDP will be adjusted. But coming to the nominal GDP is fixed based on current prices. It is not worried about the other prices, anything, or what are the changes which is taken place. It only consider the current price. But coming to the real GDP is always an inflation adjusted tool. It is a inflation adjusted. When the prices are high, so things will keep on changing. Some adjustments will be taken. And if things are already into a deflation, again, the measures will be adjusted. And this is how the basic difference between real GDP versus the nominal GDP. So one point is very clear. Real is inflation adjusted one, but where the nominal is current prices calculation. Now we'll move to the next one. Next topic. Yes. Now what is GNP? Now, the second and most important national income concept is gross national product. Now what is gross national product here? Isn't it? So now total market value of, please friends remember the total market value of all final goods and services. So how many goods and services which are produced in a country in a given period? So the total market value which is produced by a resident of a country. So very, very important. Which is produced by a resident of a country during a given period of time. This is known as gross national product. And if I want to say it in a formula, GNP is equal to GDP plus net factor income from abroad. Very, very important. So net factor income from abroad. Now here, what is the GNP means? It's the total value of all the final goods and services produced by a resident of a country during a given period of time. Now, how we will calculate it? Now, in the previous slide, we have discussed what is GDP. Now, GDP plus net income factor from abroad means people of India who are working outside or who are doing business outside, isn't it? And they are generating income in the other countries and they are sending that income to country like India, and that income is a net factor income from abroad. And here for GDP, that income is added. So here GDP plus means factor income received from abroad. Minus means factor income paid to abroad. Two things are there. Now, if we have a plus means the income we are receiving from abroad, and if it is minus means income paid to abroad. So this is gross national product. Now, next one. Right. Net national product. Now, the next important one is net domestic product after NDP, net domestic product. Now, how it is calculated? How it is calculated means it is calculated by subtracting the value of depreciation of capital assets, such as machinery, housing, vehicles from the gross domestic product. So from GDP, if we are removing depreciation, we are removing depreciation. We are removing depreciation. What is depreciation? So depreciation of capital assets. They are nothing but depreciation of capital assets. And those capital assets are nothing but it can be a machinery, it can be housing, vehicles, and which we are considered as a depreciation. Isn't it? So it is what is NDP means national domestic product is calculated by subtracting the value of depreciation of capital assets of a nation such as machinery, housing, and vehicles from the gross domestic product. And the formula of NPD can be expressed national domestic product is equal to GDP minus depreciation. So please remember, friends, now where GDP is equal to net domestic product, GDP, NDP is equal to net domestic product, GDP is equal to gross domestic product, depreciation is equal to depreciation of capital assets. So what you are depreciating means capital assets like equipments, vehicles, housing, machinery, etc. So if we do the depreciation, we are going to get the national domestic product the information. That is what the NDP is all about. Right. Now the next one is NNP. Now what is NNP? This is also one of the important concepts. What is NNP? Now, NNP means net national product. NNP means net national product. It is the market value of all finished goods and services that are produced by the citizens of a country. So please remember, earlier concept, we are considering income from abroad. But here, what is net national product? Net national product means it is the total market value of all the finished goods, all the finished goods and services that are produced by the citizens of the nation, that are produced by the citizens of the nation who are living domestically and internationally during a year. So please keep it in mind. Now, how we will calculate the NNP net national product means it is the total market value of all the finished goods and services that are produced by citizens of a nation living domestically and internationally during a year. So this is how we are considering. And the net national product can be calculated. Isn't it? It is calculated by a simple formula. You can understand NNP is equal to GNP minus depreciation. GNP minus depreciation. Now GNP, what is GNP? We have already studied in the previous slide. What is GNP? Now GNP, right. So GNP is equal to GDP plus the net factor income from abroad. Net factor income from abroad. Those are Indians who have settled in US or maybe other countries from their countries, they are sending some amount to India, and that amount is also considered here. If you add that amount to GDP, then we are calling it as GNP. Now, if you see what is GNP means, GDP plus net factor income from abroad. Right. Now, how you get NNP? The simple logic is how you get NNP. NNP is the market value of all the finished goods and services which are produced by the citizens of nation living domestically and internationally. That is what I am saying. Income which is coming from abroad is the persons who are Indians but staying outside India. So we'll consider both. That is the reason how you can write down the formula. Formula is very clear. NNP is equal to GNP minus depreciation. That is what you need to consider. So this is what the national income, most important concepts of national income. Right. Now the next one. Next important concept. What is per capita income? It is PCI. What is PCI means? Per capita income is the measure of the amount of money earned per person in the nation or a geographic region, isn't it? So it is the measure of amount of money an individual or a one person is earning in a particular country or in a region or a local geographical location. And per capita income helps to determine the average per person income to evaluate the standard of living for a population. So friends, please remember, the person who stays in Delhi, his per capita income is different. The person who stays in Hyderabad, the per capita income is different. The person who stays in Kerala, the per capita income is different, because based on some geographical region also, the money earned by person also changes. Now here, what we are not considering goods and services here to understand what is per capita income. To understand the per capita income, what we are taking into consideration is the amount of money earned by the person, by that individual person in a nation or maybe in a geographical area. Now, how you identify, how you put it in a formula way, the per capita income is equal to total income of the area by the population. Very, very important. Assume that in your area, if you are living in Bangalore, the area is some 5 crores of people are living. So total income of 5 crores. Total income of 5 crores by the total population. Now, in a country, what happens? All the population people who are living in that region will not work. But for calculation, we will consider all the people, whether they are earning money or not, we will consider. So what is the formula? What is per capita income is equal to total income of the area by total population. For example, in a place, there are 50 lakhs, 50 lakhs of population is there, isn't it? And we will write the formula, 50 lakhs. Isn't it? 50 lakhs. And out of this 50 lakhs, there are only 40 lakhs people are working. And their income is, for example, some 200 crores. Their income is 200 crores. Now, what is the per capita income? 0, 0. Now, per capita income of that particular region is 4%. 4% means out of 50 lakhs 50 lakh people who are living in that area, 50 lakh people are living in that area. So what is the per capita income? Per capita income is 4%. Means what you need to understand, friends, if number of people in that area's income is more, and total number of population people are working more and they start earning, the per capita income also develops. If number of people who are working is less in that region, in that area, so its per capita income will comes down, because per capita income is most important income, and which is used as a disposable income and a saving income. So this is a per capita income. Yes. So this is what the per capita income. And now we'll move to the next concept called balance of payments. Now, what is this balance of payments? How it is important from the Indian economy point of view? We are going to discuss. Right now, what is balance of payments? Now, balance of payment is a systematic record of all the economic transactions. Please listen. So it is a record of all economic transactions between residents of a nation and rest of the world in given a given time period. Now, please, friends, how the balance of payments are calculated? It will maintain a dual entry system record. And what type of data is recorded in that balance payments? All the economic transactions between India and the rest of the country. Now, India is doing trade with many countries like UK, USA, Russia, Pakistan, Bangladesh, Sri Lanka, big countries, SAARC countries, UN countries. India is doing trade with almost all the countries, and India is a member of WTO is also. Now, whatever the transactions between India and the rest of the world, and what are those transactions? The inflow or outflow. Either you are exporting or either you are importing. So in a given period of time, that we are considering as a balance of payments. Now it shows the inflow and outflow of foreign exchange. Yes. Now, what is the transactions? So if country A is doing trade with country B, if both are doing trade, what it is nothing. A has a transaction with B and B has a transaction with A. And AB transactions, we are considering it as the flow of or outflow or inflow of the currency. Means, for example, A is India and B is USA. Now, between these two countries, the trade is taking place, either imports or exports. The dollars will flow to India and the Indian currency will flow to America. So, vice versa. Now, what is most important, you need to understand the definition is the balance of payments is a systematic record. Now, I said it's a double entry system. It is a double entry system. Balance of payments is double entry system, isn't it? And it record all the economic transactions. It record all the economic transaction between the residents of a country and rest of the world. Means the persons who are connected in the form of trade with India, all these transactions, either you are importing, either you are exporting, all the transactions will be entered into a dual entry system ledger, that is balance of payments. Now, the inflows and outflows of foreign currency will help in understanding the country's external economic position. So this is what most important. If you know the data clearly, it becomes easy in knowing your external position. And always your balance of payment should be equal to 0. Your balance of payment should equals to 0. If it is more, then we can call it as plus. If it is less, we can call it as deficit. So whether Indian balance of payment is a surplus or deficit, so we are going to find. Yes. Now in balance of payments, we have different types of accounts because I said it's a double entry system. Inflow and outflow, all these entries will be entered into this particular. Now, capital account, it consists of capital account. Now, capital account records all the capital transfers and acquisition or disposal of non-produced and non-financial assets, which includes debt forgiveness, migrant transfer, transfership of ownership of fixed assets, etc. So this is capital account. Now, another one is a financial account. Now, what is financial account means? It records investments and loans across countries, and its subsections are FDI, portfolio management or portfolio investment, external commercial banking ECBs, reserve assets, and a balance item into a statistical discrepancies. So these are the two accounts. One is a capital account, another was a a financial account. And yes. And ideally, the balance of payment should be always equal to zero. If you want to maintain the balance of payments equilibrium, isn't it? Always see that the balance of payment should equal to zero. If it is minus, it is a deficit. If it is plus, it is surplus. So corresponding debit. So there is a current account deficit which must be financed through the capital and financial inflow of reserve depletion. So here the balance of payment should be always zero. And if it is zero, then possibility is there. Your balance of payments are under control. So this is what the balance of payments. Now I want to show a simple diagram. Yes, you want to see this diagram. Now, Indian balance of payments we are dividing into current account and capital account, isn't it? And again, current account will have goods and services. Capital account deal with capital account and financial account. So now under current account, we have goods and we have services. Goods, that is exports or imports, and services IT and BPO, tourism, etc. So under capital and financial accounting, one is a capital account, another one is financial account. Under capital account, debt forgiveness, migrant transfer, reverse, etc. And in financial account, you have to go with portfolio and other investments. Now coming to the current account, we are classifying into goods and services. Under goods, we have income uh, transfers. Income transfers is nothing but wages, dividends, profits, donation, etc. Income is nothing but interest and profits. And this is called as the structure of BOP. So thank you, friends. Today, I'm winding up the class. And in today's class, before we end the class, we'll recap what we studied in this class. So friends, we started understanding what is the national income, what is GDP, what is GNP, what is NNP, what is per capita income, and how these are contributing towards the gross domestic product, and how the income is coming, how the income is coming from abroad and going abroad. All these also considered under the national income. And after that, we also discussed about the balance of payments. Balance of payments are the transaction, the inflow of importing and exporting with India and rest of the country. And the balance of payments has a current account and a capital account. Under capital current account, goods and services will come. Under capital account and financial account will also be considered. So this is what the class for today. And this class is going to be an important class as far as the business environment is concerned, particularly the economic environment is concerned. And this is how per capita income, all these are we have discussed in the classroom. So we have discussed few formulas also. So keep that formulas in the mind. So because national income will definitely boost the country's economy. So thank you so much for joining the class. I'm signing off today and we'll meet in tomorrow's class. Thank you. Good morning, friends. Welcome for today's class. Today we are going to discuss one more important topic. Good afternoon, friends. Today we are going to discuss one more important topic, national income, and followed by balance of payments. So once again, welcome for the today's class. Today we are going to discuss what is national income and how this national income is going to affect the Indian economy from business environment point of view. Now, what is national income? So, national income is the total value of all finished goods and services produced in a country in a given year, expressed in monetary terms. It measures the and economic performance of a nation and is a key indicator of growth and development.